Cementos Pacasmayo crushed Q2 consensus this morning. They beat the street across the board.
Yeah, it was a massive beat.
Right, so top-line revenue came in at 558.9 million sols. EPS hit roughly 0.18 sols, and net income surged 61.5% to 77.2 million. Management also reaffirmed their full-year guidance.
And you can see it in the market. The stock is already up about 4% in early trading.
Exactly. But we wanted to do a deep dive on this specific report for you because the mechanics of how they hit these numbers are just fascinating.
They really are. I mean, if you strip out the noise and look at consolidated EBITDA, it jumped 34.3% to 174.8 million sols.
Which means the actual cash engine of the daily operations is just running incredible hot right now.
Right. And you don't get a 34% jump in EBITDA by accident, especially when you look at where the volume is actually coming from.
Yeah, let's get into the segments. So shipment volume for cement, concrete, and precast was up 15.5%, but the mix is what's wild to me.
It's almost entirely retail.
Right. Raw bagged cement makes up 86.3% of the segment's sales. We're talking nearly 470 million sols.
Driven by what management calls self-construction.
Self-construction. So we aren't talking about big commercial developers here.
No, not at all. This is everyday people buying cement 1 or 2 bags at a time to build their own homes.
Just paying out of pocket.
Exactly. I mean, to understand this, you have to look at the macro data. Peru has a national housing deficit of about 1.7 million households.
That's a staggering number.
It is. But 20% of that is quantitative, meaning no house at all. 80% is qualitative.
So they have a structure, but it needs a concrete floor, or maybe a second story added on.
Right. And Pacasmayo dominates the north of Peru. They cover an area with nearly a third of the country's population and roughly 20% of the national GDP.
So you just have this massive ocean of individuals constantly upgrading their homes bag by bag.
Yeah, and it acts as a bizarrely strong economic moat.
See, that's where I want to push back a little, because relying on thousands of random retail buyers seems like it would be incredibly volatile compared to just, locking in a 5-year contract with a massive developer.
On paper, sure. But commercial real estate is actually way more vulnerable to macro shocks.
Like interest rates spiking.
Exactly. If financing dries up, a developer halts a skyscraper instantly, and the cement supplier loses millions overnight.
Right, they're totally at the mercy of the credit markets.
But the self-construction market is decentralized. It's hundreds of thousands of tiny microeconomies. If a family saves up the cash to pour a wall this month, they just go buy the cement.
The interest rate doesn't matter to them.
No, because they aren't using debt. So when you aggregate all those tiny independent decisions across a third of the country, it smooths out. It creates this incredibly resilient revenue floor.
Wow. Okay, so the retail bags give them the volume and stability, but that doesn't fully explain the massive profit spike.
No, for that we have to look at the concrete and pavement segment.
Right, this is where the earnings report gets really counterintuitive. So sales for the industrial concrete segment actually dropped.
Yeah, top-line revenue there fell 2.6%, down to 66.8 million sols.
Normally, a drop in an industrial segment like that is a huge red flag, but then their gross margin for this exact same segment absolutely skyrocketed.
It expanded by 17.9 percentage points.
Hitting 16.0%. I mean, expanding heavy materials margins by almost 18 points in a single year is basically unheard of.
Yeah, they call it a regularization of profitability in the report.
Which is just prime corporate speak.
It really is. But what it means is they deliberately walked away from low-margin public works.
Like the Piura Airport project.
Exactly. They finished that huge airport pavement job last year and just chose not to replace it with similar work.
Because flat pavement is just a commodity, right? Anyone with a mix-and truck can bid on it.
Right. So you only win by being the cheapest. You get massive volume, but terrible margins.
It's like running a high-volume diner versus a boutique catering company. The diner moves 1,000 cheap burgers, but the caterer sells 50 expensive truffle dishes and actually puts more cash in the bank.
That's a perfect analogy. Pacasmayo pivoted to the truffle dishes. They focused on highly specialized mining solutions.
Like the Yanacocha Sulfuros project in Cajamarca.
Yeah, they delivered 432 prefabricated foundations for that mine. And they did it at extreme altitudes, over 4,000 meters above sea level.
So over 13,000 feet. You aren't just pouring wet concrete at that point. You're doing complex logistical engineering.
Right. They also did 4.4 kilometers of custom concrete sheet piles for the Piura River Defense Project.
So they can price for the value of the engineering, not just the raw material.
Exactly. Management is framing this as the industrialization of the sector. They're an engineering partner now, not just a commodity supplier.
Which perfectly explains the 18-point margin jump. But
Ah,
actually pulling off both of these strategies at the same time takes serious operational chops.
oh, absolutely. You have to run the factories flawlessly.
And overall capacity utilization was up. The main plant hit 62.4%, Rioja was at 75.8%, and Piura jumped to 67%.
But there's a huge operational risk hidden in the data here. Clinker production dropped 37.1% overall in Q2.
And clinker is the lifeblood of cement. It's the baked limestone nodules you have to grind up to make the final product.
Right. And at the Piura plant specifically, clinker production plummeted by over 71%.
Which is terrifying when retail demand is surging 15%. Why did it drop so much?
Scheduled kiln maintenance. They took the massive rotary kilns offline in April and May.
Wait, they intentionally took their main kilns offline right during a demand surge.
Yeah.
That feels incredibly risky, like rebuilding a restaurant kitchen during the Friday dinner rush.
It is a massive high-wire act. But you can't just delay maintenance on a superheated industrial kiln without risking a catastrophic failure later.
So how did they keep selling cement?
They burned through their pre-cooked clinker inventory, and then they had to import clinker from the outside.
Oh, wow. So they are eating the cost of ocean freight and someone else's manufacturing margin.
Exactly. And because of that, plus some higher global coal prices, the gross margin for the cement segment specifically dipped by 1.5 percentage points.
So they willingly took a temporary margin hit just to keep the retail bags flowing while they maintained the kilns.
Right? It's brilliant supply chain management. They took a short-term hit for long-term reliability.
And they made up for that 1.5% dip on the corporate side anyway. SG&A expenses dropped 7.5%.
Mostly because they didn't have to pay out a collective bargaining bonus like they did in Q2 of last year.
Right. Plus, their balance sheet is incredibly clean. Net debt to EBITDA is sitting at a very comfortable 2.3 times.
Which keeps interest expenses low and funnels more of that cash right down to the net income line.
So operationally, they basically played a perfect hand this quarter. But we need to talk about the elephant in the room regarding their future.
The Wholesome acquisition.
Yes. Back on March 30th, Wholesome Ltd., the absolute global behemoth in Switzerland, completed the acquisition of 99.99% of Inversion Aspie.
Which was Eduardo Hochschild's holding company.
Right, which means Wholesome now owns a 50.01% controlling stake in Pacasmayo.
And management is playing nice, saying they'll leverage global capabilities while maintaining local essence.
Right. But let's be real here. Usually, when a global giant buys a regional player, they come in and immediately try to force macro-scale efficiencies. They cut local channels, centralize distribution, and basically ruin the hyper-local relationships that made the company valuable in the first place.
That is the standard risk.
Yeah.
But Wholesome isn't stupid. They likely bought Pacasmayo specifically for that localized retail moat.
Because Wholesome already knows how to do mega projects.
Exactly. What they can't easily replicate from Switzerland is a fragmented retail network reaching thousands of DIY builders in northern Peru.
That takes decades of trust to build.
Right. But you can already see Wholesome's influence on the modernization front. Pacasmayo just got an official iConTech verification for their 2025 carbon footprint.
Which matters because Wholesome has to meet strict European climate mandates.
Exactly. They also secured a ConSci-Tech tax benefit for R&D. So they are actively re-engineering their cement chemistry.
So Wholesome is upgrading the back-end compliance while letting the local team handle the retail front.
Yeah, and they're investing in talent, too. Top 15 in the Merco Talento Index, #1 in cement for 11 years straight.
And they just wrapped that ALACE program empowering 25 female leaders internally.
It's a really smart balance integration so far.
So just to synthesize this massive quarter for you all, Pacasmayo leveraged a 1.7 million household deficit into 15% top-line growth via retail bags. They dumped low-margin pavement for high-margin mining tech, boosting concrete margins by 18 points.
They perfectly timed their kiln maintenance, and now they're stepping into the big leagues with Wholesome.
It's a masterclass in strategic execution. But there's one big macro question I want you to mull over as we wrap up.
What happens if the housing deficit actually gets solved?
Exactly. If the government starts heavily subsidizing formal housing or commercial developers finally build at scale in the north.
The everyday consumer might stop building their own house bag by bag.
Right. If you can buy a finished home, you don't spend 10 years pouring your own foundation. And if that retail moat dries up, does Pacasmayo have to pivot right back to the low-margin mega projects they just escaped?
It's the ultimate paradox. Fixing the regional housing crisis could actually threaten their most profitable business line.
It's something to keep a close eye on over the next few years. That's all the time we have for today's deep dive. Make sure you follow the show for your daily earnings coverage and market analysis.
Thanks for listening.
Catch you next time.